Hi, I'm Patu from FreeFinCal, and in this video, let's take a look at equity savings funds as a category. And when somebody says equity savings in the same sentence, it can only be um, uh, identified as an oxymoron. The problem is it's very misleading, and AMCs are selling this as a short-term product that investors can use with a little bit of equity in it, or they are selling it as a product for so-called risk-averse people, with people with low risk appetite and so on. So let's take a look at what this category is, and let's take a look at a couple of funds when we understand the problems with it, and why I feel that nobody should use it, and if at all anybody should use it, only under very special circumstances. So let's take a look at the SEBI definition. This is how the equity savings fund is defined. Minimum investment in equity and equity related investment 65% of total assets and 10% minimum in the portfolio. Why there should be minimum 10%, nobody knows. It's just complete BS logic. And the problem is SEBI does not say how much of that 65% should be hedged. That is, how much of that should be arbitrage exposure or derivatives exposure, and how much of it should be direct equity. This is something that the AMCs can state. All they have to do is 65% should be in equity. They can have completely unhedged portfolio. That is, all of it can be stocks, or 65% can be fully arbitrage opportunities, and the risk will be much lower. So, it's just complete nonsense. At least even before this SEBI regulations, I would say that I used to call these equity savings as the Chinese dosa, unnecessary marriage. But at least then, most of the portfolio was an arbitrage, as far as I remember. In 2014, see what happened was, when the BJP government came in, and they're in their first budget in June 2014, they had made the they had what did they do? They took away the 10% option in debt funds. That is, the taxation of the debt funds became, they changed the rules. I think they removed the 10% option, and because of that, I think the FMPs, I forget I think the FMPs, the fixed maturity plans, became unfavorable because the double indexation benefit was removed, if I remember right. I have to check. Because of that, I think the AMCs had to come up with a different flavor of funds to to entice people in search of a little bit more returns than arbitrage, and make them stay invested. So it was initially a blend of arbitrage and fixed income, as far as I remember, but now it has, because of this nonsensical regulation, things have become terrible. And if you go to the hybrid equity savings category in value research, look at the 1 year return. Last 1 year returns ranges from minus 0.76% to 9%. That's a huge spread. What that means is, each one of those funds is a different entity. Clearly, star ratings should not be applied. They're all chalk and cheese different. And if you take ICICI equity savings, and if you look at its portfolio, if you look at its current portfolio, and in value research, they have the stupid habit of showing arbitrage as cash and cash equivalents. I don't know how that's the case. So if you take this fund, it has got arbitrage exposure in, that's the grade portion, that's about 42%. Direct equity is almost 30%, and the debt is 27%. You can confirm that from the ICICI fund fact sheet. This is the fact sheet, latest fact sheet of equity savings fund. You can see that 65.77% total equity exposure. Out of that, you have to subtract out that 36.7%, which is the hedged exposure. That is the derivative exposure. Rest is the 29% equity exposure. And look at what they say. The indicated investment horizon is 3 years and above. They are having 29% equity exposure, and they say the indicated investment is 3 years and above. please recognize if there's a huge crash, and if you are going to invest for 4 years or 5 years, I know people who are investing in small caps for 3 years, but so clearly the distributors will push it for 3 years, 5 years, and so that kind of goals. And if you're going to have a huge market crash and there's going to be 20-25% equity exposure, there'll be a big hit in the return. So please don't, there's nothing called savings when it comes to equity unless it is completely arbitrage. Don't get into that. And the other problem is this is how much it has got. It's got about 27% debt, and you can see that it has got AA bonds. There can be credit defaults in this, and that's another problem. So and if you look at the scheme information document or the key memorandum, information memorandum of ICICI Fund, it says 65 to 90% equity allocation in general. It says only 15, it can have 15% minimum unhedged exposure. That is, direct stock exposure can be 15%. At all times, it will be minimum 15%, and it can go all the way to 50%. If it goes all the way to 50%, it's practically almost like it is just 15% short of a full-fledged equity-like fund. So it's extremely dangerous. They will try to time the market and get this exposure. They will try to time the market and make it provide high returns. Sometimes they'll get it right, sometimes they'll get it wrong. The debt portion can have credit defaults. Please be careful with this category. Have a look at the HDFC equity savings. It has got 38% direct equity exposure, and again above almost 30% of bonds. Again, it has got AA bonds exposure and so on. I'm not saying AA bond is bad, but it has got an A bond as well. So that's PNB, of course. But if the AA, if AAA becomes AA, the fall in the NAV will not be as much as AA becoming A. And if if the fund manager continues to hold it and that A becomes B or whatever, B minus whatever it is, then it's be very difficult to sell depending on the company, depending on the bad news associated with the company and so on. So please do not use equity savings funds at all. That is my sincere suggestion. If you want to use it for long-term goals, where you are expecting something like say 1% more than FD return with a tax efficient fund, then you can use it for 10-year goals. You can have a good amount of equity savings fund, but even then you have to get rid of it before the goal, because otherwise if there's a crash you are in trouble. So don't get into this category. It's just nonsense. But if you know how to handle the risk, you can. But if you know how to handle the risk, you might as well keep equity and debt separate for these kind of goals. You can argue why, if you're saying this, why are you advocating aggressive hybrid funds? But because in aggressive hybrid funds, I know that it will have no arbitrage in that 65%. It will have completely pure stock. So I treat it. It's a much more simpler animal to understand. This is a complex because they're changing the amount of equity exposure. Ideally, the equity exposure should be zero. If you come across any equity savings fund with zero unhedged equity exposure, please let me know and have a deeper look at it. So that's what I wanted to say in this video. Thank you as always for listening. Bye-bye.